Hello and welcome. My name is Daphné Leprince-Ringuet. I'll be your moderator for today's panel. I'm a French tech correspondent for Sifted based in Paris, and I also lead Sifted's AI and deep tech newsletter, which I strongly encourage you to subscribe to for a bit of self-promo. In the next 40 minutes, though, we are going to be talking about the AI bubble with the very people who are pouring money into it, investors at all different stages of the life cycle of startups. The panel is titled Bubble or Not Bubble. I don't think we'll be debating that. I think we can firmly establish that there is a bubble in AI. We also won't be discussing whether AI is going to be transformational or not. I think we can also all agree on the fact that it will unlock extraordinary business value for businesses and for consumers as well. What we will be discussing is how investors are juggling these two things. So on the one side, we know there's a hype, we know there's a lot of uncertainty around the technology, but also no one can afford to not jump on the train of AI. To put it in the words of one of our panelists, who I'll keep anonymous from our prep call, I quite like this quote. There are going to be a few winners. That's why we all participate in the craziness. We could choose another segment, but we don't. We are all piling up. So in this context, how do you make sound investment decisions? To talk through this, so as I said, we've got a panel featuring investors from a range of stages in the investment cycle. Next to me here, we have Xavier Lazarus, the managing partner of Elaia, which invests in deep tech startups across Europe. From pre-seed to Series B, Elaia also works in partnership with Lazarus, which enables you to write bigger checks and back startups at later stages. Hala Fadel here is the managing partner for growth at Eurazeo, a Paris-based investor that invests across Europe at all stages, but obviously Hala manages the growth investments. Merete Clausen is the Deputy Chief Executive of the European Investment Fund, so giving us the perspective here of not only a fund, but also a public investor, public actor that invests in VC funds. And finally, Cyril Bertrand, the Managing Partner and Co-CEO of Xange, a VC firm that invests at early stage across Europe with offices in Paris and Berlin. So let's dive right in. As I said, we've got different investment stages here, and I'm curious to know how the AI bubble has changed the way you approach investing at different stages. How, for example, has it changed your approach to risk at early stage, Series B and plus, and later stages? Who wants to go first?
Well, I can start with the man, and thank you for having us here and for attending to this panel. There are many things that have changed. The first one is the speed of evolution of companies, which can go very big, very high, very quickly. The second one, as a consequence, is that even at Series C, you're still a 2-year-old startup with no real organization behind. So valuations and reality of the development of the company per se are completely decorrelated. So what we believe is that in the very hyped part of which is the part where we deal with fundamental AI, Gen AI, models, robotics, etc., in the deep technology layer, here, wherever you invest, you're still early stage. And so the earlier, the better. And the checks have to, the reservation for follow-on are less interesting, because even if you pile up money at a risk level which is equivalent. So you invest the right amount day one, you create a mini portfolio of risk, and then you see what comes out. So you have to deal with AI as a subset of a portfolio and not just an element of the portfolio. And then out of it will be very good and strong companies created, then you can apply a bit more of late stage thinking. The other consequence is that AI is sucking all the money, all the talent, all the growth of the market. Hence, the rest of the portfolio, which exists because you have a legacy portfolio, because you have tons of fantastic entrepreneurs addressing things which are not pure AI, you have to deal with it knowing that first, there's no interest of the capital market for them, in average. Second, their good metrics are worth zero compared to the hype, so they will be badly valued compared to the past. And third, they need to move to some other kind of sustainability, which is defensibility against AI, usability, being a better company by using AI, and also being profitable. So there's also a massive change that goes in the background, which is the rest of the world has changed because of the AI hype.
Yeah, happy to go next. So it's a very hot topic for us, like to think how we invest as growth investors, because growth investors, I think, in the age of AI, is a very difficult place to be unless you have a large fund and are able to do large tickets. On one hand, so on the earlier side of things, companies take much longer to be de-risked for the reasons Xavier just mentioned. Companies go from 0 to 100 million in no time. With 5 people, so I'm exaggerating a bit, with 5 people on board, and from all the metrics that used to be growth stage, they are growth stage. The round size, the revenue levels they have, the customers they serve, yet they're still very risky, and you would be taking a clear venture risk. And then on the other side, the ones that are today later than Series D, because we span from B to pre-IPO, they're not what we call AI native, so you're taking also an embedded risk of, is this company going to survive in the age of AI? Is it taking the right decision to really embed AI as opposed to cosmetic AI, where you just have this small fix into the product? And so if you are to play the real role of a growth investor, which usually only takes the product, the scaling risk and not the product market fit, because at growth usually the product market fit is there and you're just here to help the company expand it globally. So you're still taking a product market fit risk on the earlier side of the companies, and then on the other side, the product market fit also is still here because they need to adjust the product to the age of AI. So the way we started looking at companies is really looking at what are the moats you can find in the age of AI? So of course there's proprietary data, there are workflows that are integrated within the processes of companies. You have distribution potentially as moat, and for us the most important metric is when we say ARR, is it actually recurring? Or if the company was born just 2 years ago, they signed up so many customers for the first year, and you don't know if these customers are going to come back the year after. So how many cycles of customer feedback did you get, and how much is the customer engaged, and how is this integrated in their processes? So we had to rethink the way we invest at the age of AI.
So maybe take those revenue figures with a pinch of salt now. Is that something that you mentioned they're quite...
Yeah, don't get carried away. And to the quote you had at the beginning, we try everything at the age of AI. No, we don't try everything, because things will disappear, and this is why probably you call it a bubble. It's not a bubble in terms of the value it's creating and the money we're putting in it. We have to put these amounts of money, but some companies will go as quickly from 0 to 100 and to 100 to 0, and this is going to be, and we haven't seen it yet. I'm very surprised.
Could you give us a scale of how decorrelated valuations are at the moment compared to previous pre-AI or pre-recent AI hype cycles and companies?
So maybe I try this one. So we are an early stage investor, right? Series A, seed, and we used to pay maybe 20, 30 times ARR, something like this, right? It was the good old times of SaaS. And today, in order to participate to this market, we would have to pay something like 40 to 100 times ARR, something like this, right? Just to put some orders of magnitudes in the conversation. And I'm guessing this is even worse on the early stage side, because the exit landscape is remaining very rational, right? Nothing is changing on the exit side for some of us who are trying to do some exits those days. The exit market is steady and paying rational prices, right? Good prices for good companies and mediocre prices for average companies. Nothing has changed on the exit side. So the enterprise is super expensive. The exit is rational. There is a trap. And despite this obvious trap, we are all participating. All of us on stage, all of you in the room, there seems to be something around that.
And as an early stage investor, how do you cut through the noise? How do you make the decision that that valuation is worth it? Hala spoke about recurring customers, proprietary data, things that perhaps appear at a later stage. How do you manage that when it's the stage before?
Well, two situations. Either AI is the product or AI is your operational leverage, right? SaaS, basically. So if AI is the product, there is absolutely no rule on valuation, I would say, at the early stage. You would pay anything necessary to beat the Americans, because essentially the market now in Europe is driven by UK and US funds. So as a European fund, if you want to participate, you have to beat the pricing of the British funds, essentially. So if AI is the product, be ready to pay whatever is needed to beat Google Venture or those kind of actors. If AI is the operational leverage, I would say everyone tries to stay rational, and I would say something like 40x or 50x ARR is going to be the new normal.
Well, I wanted to in general, come back to what you were saying about the EIF being, the European Investment Fund being a public venture capital investor, because that of course also means that we have a special role, a special responsibility as the largest public venture capital investor in Europe. We last year invested some 7 billion into venture capital funds, including, I think, not last year potentially, but my co-panelist fund managed by them. So we are in the business of ensuring that there's a steady supply of patient long-term capital for the venture capital sectors. And it's a deliberate strategy for us to support frontier tech through also periods of market volatility. And for AI specifically, this means that yes, we do see very high valuations, in particular in the US for AI companies. But even if valuation decrease, if there is a bubble, I think we will still regard AI as a technology that will drive innovation worldwide. And therefore, for us, the prime objective is to support a sustainable build-up of the sector. That means investing into access to data, into computing power, into critical infrastructure, because we believe that AI is creating critical applications in health, biotech, semiconductors, quantum computing, you name it. And these are the sectors that we as a public investor want to stand behind. And we've actually increased our risk-taking capacity in general for innovation and for disruptive tech under our Tech EU program. And we are also focusing very much, and that is something that I think has changed for us, is that we're focusing now more on the growth and scale-up segment, while still also supporting early scale. But we need, as Hala was saying, to be able to, in Europe, to offer the big tickets to the companies that need it for their growth spurts in the tech sectors, and AI included.
We'll come to the topic of scaling up at a later point in the panel. So you would say, as an LP, you are pretty prone to embracing the risk of AI?
Yes, indeed. I think this is we need strong institutional backing for risk innovation in Europe, despite the market cycles, and that's the role that we are there to play.
Cyril, sorry, Hala, did you want to bounce?
I just wanted to comment because Merete said a point that's very important. I mean, I'm fundraising. I don't know if you have finished your own fundraising. Selling Europe in AI and selling software in the current environment is not an easy task. If you're selling Europe, you're always compared to the US. Or really, do you have that many tech companies in Europe? Is the question I get from international LPs, even European LPs. And then also selling AI today, because of the volatility, because everybody believes we're in a bubble, is not easy either. So having capital that is there no matter what, like the EIF, is definitely very important for the European ecosystem.
Yeah, my next question was going to be if that's what you're hearing from, like, what are you hearing from LPs at the moment in terms of your approach to AI? What questions are they asking? What are their concerns?
Well, they are very stressed out because first, to be fair, they haven't digested their last excitement that was in SaaS in 2021. And they've seen us, and I'm saying us, I'm not excluding ourselves, but they've seen us paying 20, 30, 40 times revenues and now facing companies which have an hard time to find a buyer at 5 times revenues. So the drop of the market valuation has eaten all the performance of the companies. So now we're coming back with, SaaS is dead, but yeah, you know why? AI is interesting. And this time I don't pay 20, 30 times revenue, pay 50, 100. The LP is quite simple. They want to give you money and they expect to receive more. And our business is extremely simple. We receive their money, we have to give them back more. Whatever is inside is how we plan to do it. But we are, unfortunately, just financial investors. So if we are right and we change the world and we don't make money, we are not good. If we do deals that don't interest anyone, but we make money, we're making money, we're interesting. So this is how we have to deal. They believe that outside AI there's no value anymore, and they believe that inside AI there's no value to be done because of the prices that are paid. And because at the end of the day, if you pay 2, 3, 4 billion valuation in a European company at very early stage, to make the model work of a VC, you need to expect this company to be sold in tens of billions. And then we will go back to how many companies in Europe have reached tens of billions of valuation in private markets. The answer, again, if you take 2 or 3 names out, is 0. So you are playing very, very scarce outcome. In the US, the average performance is not good, is not better. Yet you have so many good companies that you have more winners in the lottery, and LPs believe they have a better chance. Again, the outcome in average is not that better. Yet you have the spikes of performance of the funds which are established and get the good names. So really here, it's a dilemma, but the biggest dilemma that we have to face is that they have been investing a lot in 2021. This is not divested. They are scared by that, and they don't want to pile up more cash because they have a general exposure. If we could really digest the rest of the market properly, then there would be more money and more appetite for risk. But for me, it's the combination of the two that is out in the market now.
And maybe just to add a bit of optimism to the 0 number that Xavier just mentioned on European companies. You have a few of them that fled to the US because of lack of capital, like the Datadog of this world, the Stripe of this world. I think we would have been able to keep them in Europe had we had the right capital to attract them. Because whoever invests the largest ticket at the end is very attractive to this company. So this is why I'm very hopeful that now that sovereignty is top of mind, even for entrepreneurs, and that the US, fortunately or not, has become less attractive for many reasons, will be able to deliver on those companies that will scale in Europe.
I fully agree that there are many investors now that are in Europe who are very focused also on contributing to generating some European sovereignty in tech sectors, including AI. And we see also among, for instance, institutional investors, like the pension funds, the insurers, also commercial banks, quite a lot of interest in finding ways that they can invest into VC, which is, of course, as we know, a very, very small fraction of what they invest now. And in order to help them do that, we, again, as a public investor, can help through structures such as the European Tech Champions Initiative that we set up 2 years ago, which is an initiative that is investing into what we term as mega funds, funds that are able to reach a target size of 1 billion or above, because they're the funds that will also be able to write out the tickets that companies need to become unicorns and reach valuations of 1 billion here in Europe. And we have already invested into 12 such mega funds. We're going to invest in another couple before we get into the second phase of our initiatives, where we want to attract more private investors and also potentially open up for what we term as mid-sized funds to reach a real pan-European reach scope with our initiative, also for smaller member states that do not have funds of the size that we are targeting with the first phase. We have already, and we are quite proud of this, seen investments into a number of European tech champions through the European Tech Champions Initiative, including now 11 unicorns that are growing in Europe. And this is, I think, where we are also going to be able to match the offer in the US in terms of the companies growing into a size where they can be global competitors.
As much as I think public investors like EIF are super important for our ecosystem, and thank you for being, for instance, in Xange, I have to remind everyone that for €1 of public investors, we need €1 of private investment, right? So we have to have at least 50% of our funds in public money. So two other categories of investors are interesting with respect to AI. One are the corporates or the industrial guys. And those guys invest in us with the same level of nervousness as we have, but they probably invest to see how we solve the problem of AI, you know, and because they have to solve the problem of AI for themselves. So how are you guys going to do it? And there is a second category of investors, which are the family offices and the individuals. And those guys invest in funds more to participate in the market, right? They want access, because access is a big problem in this market. We all chase 1% of the market, and in this frenzy, family offices and private investors are sometimes left outside of the market.
I want to focus on LLMs, which have obviously been the hot segment of the AI market in the past few years. Would you say today it's a wise investment decision to go all in on LLMs, so determine that this is a technology that's here to stay, it's very hyped, but it's going to generate value? Would you recommend that as an investment thesis, going all in?
Certainly not for me, right? It would be absolutely craziness to go for full-fledged on LLMs. We have very, very few foundational models in Europe. Of course, it's good that we have a few which are surviving, but honestly, how many of them across France, Germany, and let's include the UK, right? Maybe we have 2 or 3 at best, Mistral in France, for Black Forest in Germany, and a few others, but not very many, right? So it's absolutely not sufficient. And maybe if you are happy enough to find one, it would be 1 in 20 companies in a portfolio, but not more than that.
I should have maybe been a bit more explicit in the way I phrased my question. By all in, I meant obviously there's backing the LLM technology themselves, but also I think you mentioned Mercor during our prep call, companies that are fully dependent or building the infrastructure for this specific technology is also what I meant by my question.
So first, the technology behind LLM is here to stay. It has shown tremendous results in the language. It's completely limited to language or image creation, etc. So it's not enough to consider that it's done for AI and we have somebody doing the foundations and there's nothing more to be done. The case of Yann Lequin building something on real world AI is interesting, but you have a lot of things. For example, LLM costs a lot to do things that old-fashioned machine learning can do very well. I remind you that the Alpha Zero, which is barely using no resources in compute, is 2, 3, 4 times better playing chess than Claude or ChatGPT, who is using way more resources to do that. So LLM is not the unique technology behind every kind of AI, yet it's the language. And language is the UX between humans. So we speak. So even in a very sophisticated, complex AI framework, at the end of the day, LLM has a role to play, which is interaction. So I do believe LLM will stay. Is it done? In terms of capacity, pure capacity of ingestion, bigger models, I think it's plateauing. So it's not interesting anymore. Yet, efficiency is a question, usage, how to transform their thinking, which is statistical prediction, into actions, agents, there are tons of things to be done, and understanding mastering LLM is key, because if you build up on OpenAI or Anthropic and they take all your margin, you are back in the year 2010 when you were creating e-commerce companies and all your money was going to Google and Meta. Because this is where the value was created, which was addressing the customer and not selling the product. So at the end of the day, people are working still on LLM to make them controllable in cost, in efficiency, usability, etc., hallucinations. So there's a lot of work to be done, but on the fundamental things, research has been done in 2018 by Google, and since then it's just engineering.
Yeah, maybe just to complement what Xavier is saying, and I mean also what Cyril just said, LLMs are really a tool. It's the backbone infrastructure. Even the LLM players themselves are getting into how to use these tools and how to apply them to real life problems. As Eurazeo, so not from the Growth Fund, but we're in every single European LLM, from Mistral to Amilabs to Gradient AI to Bioptimus. So all those are here, I mean, with the small tickets, just to have a foot in and see how maybe with time, as they apply those models to their specific area of expertise. So for example, life science for Bioptimus, or voice for Gradient, and enterprise applications for Mistral. We'll see how they evolve, and maybe at some point they will become investable from a growth fund perspective. I think it's very exciting to see how AI and the use of those LLMs will move from a tool that is augmenting us to a tool that actually operates for us. And this is when the real value creation will come, with the automation of certain tasks, as opposed to, you just used it to prepare your panel, and maybe it does the panel for you. So that's, or within an enterprise, helping you be more productive in preparing your accounting to doing the full accounting of a company for you. And this is the step change that will make them, investable, and really a big pillar of productivity for an European competitiveness.
Last week we had a very good example of what I want to mention next, when Anthropic released a tool that could automate legal work, sending shockwaves across the sector and making, I think, a lot of startups pretty much freak out. In AI, it does feel like startups are constantly at risk of being wiped out by the next tool that a big tech giant in the US is going to release. How do you navigate that in your investment decisions?
It did not only freak out small startups, right? The big SaaS companies in the US with the Bessemer SaaS index went down 20%, something like this. So if the big guys are scared, what should we be, right? That's my question. I think we should all be nervous, right? And still act, as Merete was saying, right? Of course, we are nervous, but we still invest. At the operational leverage, to your question, Daphne, I think we lack today a clear vision of how AI is going to improve software. Currently, AI is sometimes actually destroying gross margin, is not very clearly improving operational excellence. So we are probably at the beginning, but it's not a very pleasant situation to be in, right? Gross margin can be down to 30–40%, very far from the standards of SaaS. Of course, growth is there, absolutely, but operational excellence, are we doing much more with the same number of sales guys? Not very clear today. So that's probably where we need a lot of improvement.
Yeah, I think also that the best advice I think you can give to the startups is that, well, leverage on the public and private financing that is there in Europe, because it is there. You need to find it, and then you need to probably also go through some hoops to get the financing, but it is there. And we are trying to bring in as much private financing as well, because I fully agree with Cyril that with only public financing we will not manage. And then I think a good advice is also to try and build in the sectors where Europe has strengths. So for AI, this is AI applications, as I was speaking about before, in areas such as health, green energy, industrial automation, also areas that will help us build up the sovereignty in Europe, the capacity in Europe that will make us more resilient to market volatilities, but also to situations where we become too dependent on the world around us.
The interesting, well, first, if we were to move on every excitement or deception of the plowing market, we should be playing the plowing market. So we have to be consistent. We have to keep faith in what we do in the long term, but we have to take into account what's happening. And our interpretation is that there was nothing new in technology last week. What Anthropic released was something that was in the plan, so there's no breakthrough in technology. Yet they showed that they could make a good enough cheap product that was comparable to the extremely expensive offers of Bloomberg, of Reuters, Thomson Reuters. So what was, for me, the movement of panic in the market is that the software model is a model of monopoly, of very high margins, more than 85%, and customers which are stuck forever. AI is saying just we are breaking monopolies, potentially. So they could be us, that could be anyone, or they could be the software companies reinventing themselves. But the pricing power that they had in their hands may disappear, and you will be back in control of your power. We know also, by the way, it's a trap, because this is how Uber started in Paris and every city, dumping prices, and then when you're stuck, they put the right prices. This is all the time it happens. So first, hope that the companies and the sector is a bit smarter than the consumers were. And second, that's the reality. Technology prices should go down over time, and in software, they never go down. So software now is at the edge of maturity of being facing a revolution. But it's not the end of a sector, it's not the end of anything, it's just adaptation, and adaptation means maybe less cash flow for the big guys, and if there's less cash flow, there's less profitability, less value, and we have to adapt. But there's no panic for me in the sense that the technology play and the independence, sovereignty, and value is still here. We just have to adapt prices of companies, margins, business plans to the fact that AI will put pressure on revenues on every software company.
And they will have to raise prices because they are losing tons of money, so they will have to raise prices.
At some point they will do that too.
Yeah, maybe just a comparison to the previous cycle of innovation around the internet, where the winners of the age of the internet were completely different from the winners pre-internet, apart from Microsoft. Like you had the emergence of Google, of Meta, of AWS. So today you see that those large players have an advantage because they have access to data, because they're integrated with the enterprise, because they have distribution. So these large players, the jury is out whether the winners will only be these large players, or if you will also have some smaller players emerging, and the smaller players are more nimble, more agile. They integrate AI both on operational leverage, to Xavier's point, but also within their core AI offering. So that's also an advantage. And for us also as investors, the big software players will have to have an AI offering, and I'm not sure they're able to recruit the best of talent in AI. So it's an exit opportunity for our portfolio in terms of acquisitions, but then we need to be careful at what valuation we enter, because they won't be paying billions with an S to acquire them, maybe one or two, but not more than that. So it can also be an opportunity, this awareness that they have today. I'm not sure it's exactly post the Anthropic release, but an awareness that they really need to put their act together and be ready for the next phase of AI product offering.
Is that would you say that's a more realistic exit for most AI startups today, M&A, or are you still trying to back the champions, the 11 Labs and Mistrals that are going to potentially become the next huge players, or is it a balancing of both strategies?
Well, it is definitely an option. It depends, again, at what valuation you entered and what type of of companies you invested in. So for example, we invested in Cognigy, which is a German company doing AI for customer support that just got acquired this past September by NICE, which is one of the largest customer support company listed in the US. So that played out well in terms of value creation, maybe not necessarily for European sovereignty, but for value creation for our LPs, it definitely worked out well. I think there are segments that will definitely be very good acquisition targets. So customer support, CRM, because you have the Salesforce of this world also that need to put their act together. So all those big software companies, SAP, will need to make acquisitions in that space because they're probably the company that is most prone for disruption today. ERP systems are just horrible from a user experience perspective. So it is definitely a very good option for exits for our fund. The other bets for companies that would go as standalone companies for a long time, I would say they're riskier today because we don't know who the winners will be. It's very uncertain times. So they might be very promising, but it's still, there are still bets.
Cyril, Xavier, Merete, how do you approach the exit question?
The IPO should be the target of the best in class, always, but especially in AI because of sovereignty. Mistral shouldn't be acquired by anyone, even by European company. We have to create our own options, so we have to have a few bets where they should be pushed towards IPO, and then public investors should accept to invest in a company that might not be yet cash flow positive, etc. On the mid-market, usually you have two routes. One is strategic M&A, the other one is private equity. In the case of the AI companies, because of the margin that Cyril mentioned, PE should not invest, or normally shouldn't, because they will not be cash efficient, because the model is not cash efficient yet. It's still a venture kind of play. So there should be some M&A strategic, and there should be also some secondaries, because sometimes the early investors will reach the point where there's new investors is willing to invest more. There's not such a need of capital increase, etc. So we have to find new ways of exiting there, because classical PE is not meant to come. The important part is portfolio management. If in the portfolio we have a few M&As of good companies, a couple of secondaries of PE exits, it means that we return early money to the investors, so we can ask them then to be patient on the leaders. What we can't ask them is to be patient without any news in the meantime, but portfolio management is good, because then if they receive cash, then we can say, and for this company will play all in. If it's taking 15 years, it's 15 years. If we IPO, we IPO. If we have to stay 2 more years after IPO for liquidity, it's 2 more years. If we have been doing well in the rest of the portfolio, they would agree. So the fact we can play IPO from time to time is also because we can play M&A strategy from time to time.
30 seconds each, if possible.
Yeah, the way we approach it as a fund of funds is we want to work with fund managers who have specialized strategies in helping companies, be it with an MIA targeted strategy or an IPO targeted strategy. So fund managers who can help companies pre-IPO, during an IPO, but also post-IPO. Or another example, working with fund managers who, we had one who had specialized in helping companies helping buying companies in portfolios of big corporate buyers who had lost interest in developing them. And this fund was specialized in then buying up these portfolios, the companies, and helping them to grow and become more productive. And this is the type of strategies that we're looking for among our fund managers.
In AI, we may see something that is at play in the US, which is, for us, we exit a company, a small-size company, to a mid-size company, which is still growing very fast. So we don't make a super multiple on the first exit, but we stay in this, let's say, this a few $100 million companies selling to Penny Lane a few billions, and this company is still growing quickly. So we may see that a bit more in Europe with AI.
I think that's all we have time for, so thanks very much to all of you, and I hope you enjoyed the talk.